The Senate is debating a bill that will radically change the EV tax credit, and today I want to kind of break it down. So welcome back to All Cars, y'all. I'm John, and when I saw this morning that there was a new bill being pushed forward and one of the senators had changed his opinion, I really didn't think much about it. I honestly just thought they were going to extend the tax credit that we already have, which is $7,500 if you buy an electric vehicle and a cap of 200,000 units per manufacturer. But wow, no, this is a lot more complex and in a lot of ways a lot more comprehensive. I want to break it down. I found a summary of it. I did not read this entire 725-page bill, but I found a really good summary of it. But it still has, I think it was 28 individual items to talk about. I'm not going to cover every single one of them, but this is a big change. And at the end, because I do news opinions, I'll tell you what I think about it all. So the first thing is this would take effect if it is passed the Senate and it gets to the president's desk and he signs it. This will take effect on January 1st, 2023. The first big change, the manufacturer cap is eliminated. There's no longer a $200,000 unit cap. So if you are a tiny manufacturer and you're selling 40,000, or you are General Motors and you're trying to sell 1 million, or Tesla, then it doesn't matter. You still get the credit. This is going to really level the playing field for basically everybody. I'm not sure that's a good thing. There's going to be a transition period. This is written really weirdly, so I don't want to break it down in too much detail, but basically it reads that if you enter a sales contract before the president signs it in 2022, but you take delivery in 2023, you get the old credit. That's how I read this, and that's what I think that means. I would verify that a little bit later after this bill moves forward and gets a little more analysis of it. But big change number 2 is the vehicle must be assembled in North America to qualify for the credit. That leads us into number 3. The credit is no longer based on the size of the battery. It is actually broken down into 2 different pieces. So it's still $7,500, but the first $3,750 is based upon the vehicle having at least 40% of its battery critical minerals from the United States or countries with a free trade agreement with us. And that would be like Australia and Canada and Korea, as a matter of fact. The other $3,750 is based on at least 50% of the battery components of the vehicle coming from the US or countries with a free trade agreement. Okay, so $7,500 total, $3,750 based on where the minerals are coming from, and $3,750 coming on where the battery components are coming from. Now those 2 requirements are actually going to step up in percentages by 10% a year, so that the mineral one actually tops out at 80% in 2027, but the battery components have to actually reach 100% by 2029. Beginning in 2025, any vehicle with battery minerals or components from a foreign entity of concern are excluded from the tax credit. Now, I don't have a list of what these entities of concern are, but I think we can probably all reach into our basket of common sense and think about that one. There's only 1 credit per vehicle. They have to spell that out. But they also have income limits for the purchaser. So if you have $150,000 as an individual, $225,000 as head of household, or $300,000 for joint returns, you will still qualify. The MSRP is also applicable here. So the vehicle must be under $80,000 for SUVs, vans, and trucks, and $55,000 for all other types of vehicles. I have read joked that means that, congratulations, the Tesla Cybertruck just became $79,999.99. The dealer can apply the credit at the time of sale, but they do say that it must disclose the MSRP, the credit from the federal tax credit, and then any other credits that are applied as well, whether it's dealer or state, for example. And that the credit terminates on December 31st, 2032. This is a 10-year program they're rolling out here. That's all enough to talk about, but it's bigger because they've instituted a tax credit for used vehicles as well. Now, the first thing to know here is it can only be used once, and it has to be used on a vehicle that is bought from a dealer. It's a 30% of value up to a $4,000 cap. The used vehicle must be at least 2 years old at the time of sale. The price must be $25,000 or less. The purchaser must be an individual. The purchaser can only claim one credit every 3 years. And they do have income requirements as well. And this is for $75,000 for individuals, $112,500 for head of household, and $150,000 for joint returns. And of course, the credit may be applied by the dealer at the time of sale. Now, this is a big change, and honestly, I have mixed feelings about it. This is not a political channel, so I don't want to wade into this, but it makes me question somewhat what the motivations are behind here. First off is they're trying to make the EVs more affordable, and they say they want to use EVs because it's friendlier on the environment, and I believe studies show that, whether you're a fan or not. But it's a little counterintuitive. Why are you increasing the purchase price to SUVs, trucks, and vans, but lower on other vehicles like sedans, if they're trying to program us to buy more fuel-efficient vehicles and incentivize us for it? Why are they doing so on the least efficient vehicles instead of a sedan, something like a Model 3? I don't really know that I buy that. I do kind of support that it has to be built in North America and that it has to use increasing amounts of components that come from America or friendly nations to America. I do kind of support that. But this interestingly does cut out one of our big trading partners, because right now Hyundai Kia, they couldn't sell their EVs with this tax credit because they're assembled in Korea. Now, I believe like the ID4, they have moved construction to Tennessee now, so it sounds like it'll be ramped up. But fascinatingly, this may or may not help some other companies like VinFast that's building a factory here and should be in operation by 2024. Those initial vehicles are going to be built in Vietnam. I'm not sure if it qualifies because I don't know where those batteries and their minerals, those components and the minerals are coming from, but I do know they've partnered with Pelagium and they're building a factory over there. I think it's going to be mostly Chinese stuff, and I'm not really sure that it's going to qualify. So this is a giveth and taketh away. I'm up in the air about it, guys. I have mixed feelings. Why does Tesla, which can't build enough cars, get another $7,500 off when somebody like VinFast that's trying to make it more affordable isn't going to get one? You know, what giveth taketh away, right? The last thing I'm going to say here is that while they're trying to make it more affordable for people to buy EVs, to increase the adoption of EVs, and in conjunction with them spending however many billions of dollars it is to increase the number of charging stations out there. But the question is, if they want to increase EV adoption, putting in more charging stations is one of the ways to do it. Studies have shown that increasing the number of vehicles does not increase the long-term adoption relative to increasing the number of stations. So to put it another way, if we incentivize you to buy the vehicle, but then you end up frustrated for the next 2 to 5 years because you can't ever charge it, you're going to want to go back to a gas car. If we have enough stations where it's convenient, then all of a sudden EV adoption comes along. Well, if you've got incentivizing people to make the EVs more affordable in an economy where demand is there for the EVs, manufacturers have already said they're moving to EVs one way or the other. Before this ever passed, we know that Ford and Chevy and everybody else, they're rushing into the EV world. This is just going to put a upward price on the pressure. And I hold up as an example the Chevy Bolt. It was priced at a level, and once Chevy's 200,000 cap was hit for EVs, once General Motors was, they dropped the price because it wasn't being artificially inflated by a tax credit. I'm afraid that some downward pressure that the marketplace would be putting on EVs is going to be eliminated. Why do I have to be more competitive if there's a credit over here? So I think this is actually going to be a little counterintuitive, but I do think it's going to probably serve its job of helping to incentivize people to remove some of that fear and to move into EVs. But it's a huge change, And I'm really interested because I did not expect the used vehicle credit. That doesn't remove my concerns about a used vehicle and a used battery, but at least these high prices on these older ones, this might help take care of that just a little bit. So big topic, guys, but really short video, I hope. Go ahead and let me know what you think below, whether you think this is a good idea, a bad idea, whether you support it, and whether you think this will help with adoption or not. Appreciate you being here.